9 months ago, I showed a video from Jeremy Grantham. Today, I'm going to do the same thing. I think you'll find him insightful, as always, and I follow him, I respect him, and I will be showing you some other videos that will talk about the issue that a lot of people are looking at, and that is risk versus reward in the stock market. Hi, I'm Ben Reppond. Welcome to my YouTube video. Today is February 28, 2023. I'm going to start with this first video from Jeremy Grantham. The reason I show him is because he is one of very few that I know of that got it right in predicting the crash of the dot-com bubble in 2000 and 2008. There were many who did not get it right, who thought the market was going to the moon. Or they didn't say it that way, but that's really what their words implied. That includes Abby Joseph Cohen from Goldman Sachs, Henry Blodgett from Merrill Lynch, who was following the tech sector, and others who just, and frankly, Jim Cramer. They just piled on, it's going to keep going, it's going to keep going. Well, it didn't. Jeremy Grantham is one of those people who said, no, that's not going to happen. This is going to end in a crash, and it's right in front of us, and he was correct. He did the same with the 2008 crash. So those are the reasons why I followed Jeremy Grantham. He says that when he looks at the market, he says this is a lot like 2000, the tech bubble. There are characteristics that are different, but then he says it morphs into the 70s. And in the 70s, we had high interest rates, high inflation, high commodity prices, low unemployment. A lot of characteristics were similar. And what happens is the point where the risk starts to increase is not apparent. So this is counterintuitive. When everything is going well, think like it was in 2007 or 1999, going really well, and then it crashes. And then so many people, some of whom I've named, are like, whoa, where did that come from? And Jim Cramer even said later, he said, sometimes the market does something that just takes your breath away. Well, he experienced that. And Jeremy Grantham doesn't take that view. He says when those sort of euphoric periods occur, that's when the risk is the highest. Exactly the opposite of what the human emotion wants to believe. He said that in 2021, before the 2022 decline. 2022 was not a crash. It was a decline. It went down, the market, S&P went down about 24% and at its worst point, and then ended the year down about 18%. But never during that period was there what you would call a crash. So anyway, he's going to speak to this, of where we are today relative to 2000, and really the idea that this really morphs into, really goes back to actually the 1970s. So take a listen to Jeremy Grantham.
I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan, and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. And people never get it. People never forecast it. And along with the recession comes a drop in profit margins. Going into the bubbles breaking, profit margins are always at a peak. Bubbles don't peak for no reason. They peak because economic conditions are nearly perfect. And that includes low inflation and high profit margins. And the first thing to go in a recession, of course, is the profit margin. And that is very likely to happen this time. We should be in a recession, mild or severe is the question, but we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline. And if you want to get into the longer term, I think this kind of 2000 bubble that we have is dangerously likely to morph into the 1970s, where inflation is always a part of the background discussion and where growth rate starts to dwindle away. So you have shades of stagflation as we had in the 70s, where commodities are intermittently scarce, price jags here and there, as we have seen recently, where the whole system is so strung out and so borrowed that it's lost its resilience. All you have to do is cough in COVID or a war in the Ukraine, and you see the problems ricocheting around the system that was not designed to absorb any kind of punch. Last minute inventory delivery, no reserves, putting all of your business with one country far away. No flexibility, no resilience. And now we begin to pay the price.
Next, I'm going to show a video. So Grantham talks about he's more of a macro view. He looks over the last 100 years and to look at these macro cycles. And that's what he's seeing, is that we're entering the phase of a new macro cycle, down cycle. Now I'm going to look at those who are more tactical, who are looking at more the here and now, what's going on this week, this month, this year, and who are not taking a macro view. So I'm going to show you both. This one is CNBC. Melissa Lee is interviewing Kristen from Citibank, and she takes the view, she looks at two metrics. One of them is retail sales, which is slowing, and credit card debt, which is increasing. So take a listen to Melissa Lee and Kristen Bitterly.
For more on what's next to the markets, let's bring in Kristen Bitterly. She's Citi Global Wealth Management's head of North America Investments. Kristen, great to have you with us. We were just talking about the mixed signals that we're getting about the consumer when it comes to the high-end consumer versus the low-end consumer. I'm wondering where you stand on that and how that educates your view of what the risk reward is in the markets right now with the S&P, at 4,000 roughly.
Yeah, you really have to look through the data because I think the headline data can actually be pretty confusing. So for example, one of the data points that came out recently was around retail sales. And at first glance, it looked really strong at plus 3%. But there are a lot of adjustments that come in, especially in that January data, to factor in seasonal adjustments. So the unadjusted data was a decline of 16%. And so in reality, what we're paying attention to are things that are changing the consumer behavior, changing their spending patterns, because that's 65%, 70% of GDP. And so credit card balances, we're keeping a close eye on credit card balances, which have already eclipsed pre-pandemic highs. Consumers have already spent through that stimulus, and now they're actually spending based on credit. And so their behavior, we're starting to see these changes in terms of trading down, whether it's in the retailers spending on durable goods as opposed to discretionary goods. And so these are all things that are going to affect numerous parts of the economy and definitely corporate earnings.
Next, Quintanilla and Sara Eisen from CNBC interviewed David Rubenstein from Carlyle Group, and he explains why the market went up in January or in early February, and then started to decline in the latter part of February. What's going on with the market? And he contends that inflation is still high, very high, and it is got to come down, according to the Fed. They're resolute in this. It's got to come down to 2% to get it under control. And I think I don't know what the number is they're going to end up, but they keep saying 2%. Well, if it's at 6.5% today, in general, the CPI number is at 6.5%, and they're trying to get to 2%, that is a lot of slowing of the economy to get inflation down to 2%. And oftentimes what they do is they don't just get it to their target, they oftentimes overshoot their target on either the downside or the upside. So it is entirely possible that they will overshoot it and we will head into deflation, and then they have to start lowering interest rates, easing. So I don't know. But I mean, right now, he says 2%, we're a long ways to go. And the market just got ahead of itself in January. The market wants to go back up, and it's like, okay, we're done with 2022. Let's go. It's 2023, and the market took off. Well, it got way ahead of itself, and now I'm going to show you some data coming up that now inflation is stubbornly high and actually increasing. Inflation is increasing, not decreasing. And you can point to certain aspects of the economy and say it's decreasing here or here, but in general, I'll show you the data. It shows that inflation is actually increasing. Anyway, listen to Carl Quintanilla, Sara Eisen, and David Rubenstein.
Carlyle Group's co-founder, David Rubenstein. David, it's great to have you. Thanks for joining us today.
My pleasure to be here. Thank you for having me.
You've been pretty clear, even when the market sort of doubted it, that inflation would be persistent. Do you regard these last few weeks as the market coming around to what Chair Powell has been trying to get across for months?
I think the market is finally recognizing that inflation is not going away. The Fed is resolute. They made it clear several times recently that they really want to get the inflation rate down to 2%, not 3%. And therefore, I think the market takes the Fed very seriously. But that doesn't mean we're going to have a hard landing or a so-called recession. It's just too early for anybody to really know where that's going to happen or not.
Do you think, David, it's Sara, that the market got too excited just over the last, few weeks and month about a Fed pause and a Fed pivot? You spoke to Fed Chair Powell. I don't think he sounded particularly dovish. Do you?
Well, I don't want to characterize it, but I would just say that he made it clear that they are determined to get the inflation rate down. And I think the earlier expectation that maybe there would be rate cuts by the end of the year, I think that's out the window based on what we now see and what he now sees. Clearly, the market could change, the world could change. But based on what the Fed sees now, while I'm not obviously authorized to speak for the Fed, I think the Fed is probably not going to decrease rates this year. And that, to some extent, is being reflected in the stock market.
Next, I'm going to show David Westin from Bloomberg is interviewing Larry Summers. And Larry Summers contends that the indicators on the surface look positive, but when you get underneath it, there's a lot of weakness. And again, concern that the Fed has got more work to do, that we're not where we need to be, and that it's going to show when the Fed does its job of raising rates and selling assets, it is going to weaken the economy further and probably push us into a recession, further into a recession. There are some leading indicators he talks about. For example, inventories are building, sales or orders are slowing, and debt, short-term credit card debt, is increasing. Take a listen to David Westin and Larry Summers.
Let's start with those Fed minutes. We were all waiting for them. They came out. I'm not sure they indicated the Fed is heading in any different direction than what you've been saying.
Those minutes were superseded by history in terms of the strong CPI print, the incredible job market creation, and the retail sales. So I don't think there was anything much informative in them. Look, I think we've got an extremely difficult economy to read. On the one hand, we got a set of very, very strong statistics. I think the data are coming in a way that confirms the view that I have had for a long time, that inflation does not get back to 2% without a meaningful slowdown in economic activity. Yes, inflation may over some intervals come down, but that's really mean reversion from the transitory increases that took place. But that's not enough to bring us to enduring 2%. The other big uncertainty that we have is that while so-called coincident indicators, things that move right along with the economy, look very strong, there are a variety of leading indicators that are more troubling. Inventories look to be building up relative to sales. Firms are reporting concerns about their order books. It looks like the business sector has a lot of people on hand for the level of output they're producing, and consumer savings are being depleted with a low savings rate, and who knows where the market's going to go next.
Now I'm going to play another clip from David Westin, and here he's interviewing Liz Ann Summers from Schwab and Greg Peters from Prudential. And Liz Ann Summers contends that the primary indicator for looking at the market, what happened in January where the stock market took off, is that it got disconnected from the bond market, and now it is reconnecting to the bond market, and that is the best indicator of what's going to happen. She says there's going to be more rate hikes ahead, more than even we expect. And then Greg Peters points out that, again, he believes she's right. The market got ahead of itself in January, and we have a very rough road ahead. Take a listen to David Westin, Liz Ann Summers, and Greg Peters.
So, Liz Ann, let me start with you. Are the markets starting to come to terms with what's likely to come? And if so, what is likely to come?
So, yeah, I do think that the stock market is going through a bit of a reset. There's the old phrase actually coined by my first boss in this business, the late great Marty Zweig, who was part of the original Wall Street Week for many, many years. And he coined the phrase, "Don't fight the Fed." And I've been getting a lot of questions. Do you think stock market's been fighting the Fed? I think the stock market's been fighting the bond market. And the messages from the bond market, I think, have been telling a more accurate story. And there was a disconnect there for a while, certainly a big part of the rally in January. Now I think the equity market is coming to terms with the fact that the job is not done for the Fed. They probably have to hike at least maybe once or twice more than what was even built into expectations a week ago, because the inflation data continues to be, I think, too high for the Fed's comfort zone. And now I think the market, the equity market is adjusting not only its expectations, but some of the embedded leadership trends that I think were sending a different message in January.
Greg, do the different indicators in the market really agree with one another? Are they pointing in the same direction? Because you have things like, at least until recently, really pricing in price cuts, rate cuts across the board. At the same time, we've got a very tight labor market. We've got a really inverted yield curve. What does this all add up to?
Yeah, so it has to be reconciled, David. And so I agree with Liz Ann. The equity market is fighting the bond market. The bond market is telling you, with the inversion in the curve, and it just priced out the cuts, but it's still telling you that rough roads are ahead in terms of the economy is concerned. Yet risk markets have been flying up until recently. And so I think what 2023 is really going to be about is reconciling those two markets. So you can't have an inverted yield curve that's predictive of a recession and equities and risk markets rallying as hard as they've been. So I think it's just the start of it, to be honest with you.
Next, I'm going to show a very brief piece from CNBC's John Fort and JP Morgan's Chief Global Market Strategist, Marko Kolanovic. And Marko Kolanovic contends that we are going to see more downside pressure on equities from here. Take a listen.
JP Morgan Chief Global Market Strategist Marko Kolanovic joins us now on the newsline. Marko, you were just saying, a week ago, that the market had gotten ahead of itself, was tempting fate, baiting the Fed. Have we gotten enough of an adjustment today, do you think?
So I don't think we got enough. If you look basically the day after Fed, 2-year was about 410. Now it's 470, and Nasdaq is basically flat. So we had sort of 60 plus basis points increase in 2-year yield, and Nasdaq just gave back a little bit of the gains from the last few days. But I do think we could see more downward pressure here.
Now I'm going to get into some economic data, some economic charts, and this will support what I've been showing you on these interviews. This came out, this is Jeff Cox, who is an economist with CNBC, and the headline on this was, key Fed inflation measure rose 0.6% in January, more than expected. Now keep in mind, when it's 0.6, I'm going to show you some data on this, when it's 0.6, What that is a month-over-month number. So you have to annualize that, or look at the sum of the monthly numbers for the last year. But one way to look at it would be to annualize it. Well, that tells you, if you just annualize 0.6, that inflation is over 7%, running at a rate of over 7% per year. And this was higher than expected. And there was this thinking, optimistic thinking, that the market is going to do well. We're done with December. We're done with 2022. We're on to better times ahead. And it took off. And then in came the inflation numbers and other reports showing that we still have extremely high inflation, and in some cases it's going up. This is a chart showing the personal consumption expenditures called PCE. And this is a month-over-month report, so it's comparing, this is not an annual number, this is just comparing the increase or decrease relative to the previous month. So when you see on the far right of the chart, the red bar, you can see how very high inflation is. It's going up. Look over the past several months. It is definitely going up. And that's an indication that the Fed is not done. Like Liz Ann Summers says, we're not only going to see the increases that we are built in, which I think there's about 3 increases built in between now and June. I think she contends that we're going to see even more increases than those, and it may even get aggressive if their target is to hit a 2% rate of inflation. What that translates to is a crashed economy. When you bring that rate down from 6.5 down to 2, that's going to crash the economy, or it's going to put the brakes on the economy, and maybe it'll just feel like it crashed. And the same for the stock market, because the stock market does not have that built into it. So I think there is caution ahead when you see charts like this. This is the core inflation model relating to the personal consumption expenditures, PCE, and again, month-over-month numbers, but it's the core number. So when you look at core inflation, then you can see how stubbornly high it is. And you go back to 2020, of course, it went down for a period of time. Everything went down that month. But this is pushing some highs right now. And it's saying to the Fed, if you want to get inflation under control, you've got a long ways to go. The Kansas City Fed Manufacturing Outlook, it's a survey, and you can see where they believe that the outlook is for the orders from manufacturing. Now I'm going to switch over to homes. You look at homes that were bought by investors. This is not owner-occupied. So this data relates to non-owner-occupied homes, but you can see where it went to. You remember when it was hot a year or so ago, and look at where it is today. I mean, it is coming down fast. And so it is decreasing significantly from where it was. Why? A lot of that money was leveraged money, leveraged with mortgages, and that's expensive money today, relatively speaking. So that is slowing the housing market. The housing market where I live, a friend of mine who's a realtor said that the market in this area is down 10% from a year ago, prices. And that sounds about right to me. And those people who are thinking, I want to sell my home and I want to get this for it, they remember what it was worth or what similar homes were being sold for a year ago. That's not reality today. It's down 10%. In some cases, maybe not as much. In some cases, more. Depends on the type of home. Wayfair is an online retailer of furniture. They're a large retailer. They lost 5 million customers last year, and $1.3 billion in revenue. So that is showing up in the retail sector and retail numbers. Because of this issue around inflation and what the Fed is going to do, this is being anticipated in the bond market. So the rates, and this is just the 2-year government bond, the rates for the 2-year government bond are going up and up. And what that means is the prices of those bonds and other government bonds are going down correspondingly. So what that means is that traditional portfolios that include bonds, which is a lot of portfolios, are bond funds. Those are being hit hard with this new data that's coming out that the Fed is going to have to be more aggressive, raising interest rates, which means bond yields go up, which means bond prices come down, and the portfolios that contain bond funds and target date funds and 401k plans, those are coming down as well. Bond yields go up and down. And so the 2-year bond, I just showed you that, goes up accordingly. The 10-year bond is similar, but it does not go up as high. And the 20-year bond goes up, but it does not go up as high. So when you plot the spread between the 2-year and the 10-year, and the 10-year being the numerator, the 2-year being the denominator, what that means is if this goes down, it means that the 2-year is stronger, the denominator is stronger than the numerator. The 2-year is stronger than the 10-year. That is not the way it's supposed to be because people are usually paid a premium for the longer term duration bonds, except when it is preceding a recession. So when this chart, the graph, the plotting of this graph goes negative below the 0 line, that is the foreshadowing, traditionally, for back to 50 years, the foreshadowing of a recession. So the degree to which this declines is the degree to which we are probably headed into a recession. It's called the spread, the bond spread. Okay, now I'm going to show the flow of funds report. This shows, again, I'm reading this, money is flowing out of equities into bonds and into money market funds. Last week, $9.6 billion went out of equity funds. $7.1 billion came into bond funds, and money market funds had an inflow of $4.8 billion. Again, this data is more shows more of a defensive nature in the investment world. I thought with this new car, we'd be getting better gas mileage. There is an anchor, a weight on the economy, and the weight is inflation. We are not in a growth economy at this point. A growth economy is not going to happen from here if, with one condition, if you believe data going back for the last 100 years. Growth markets do not happen from this kind of structure. In order for a growth market to occur, we've got to work out the excesses out of the system, and then once the excesses are worked out, value starts to come back into the market, and the market then takes off. We are a long way from that. And a friend of mine who manages a mutual fund, he writes a piece. I respect him. He writes a piece every week, and he, like many, and no criticism to him at all, but he, like many, got sucked into the market. We went into the market for a period of time in January and in early February. Fortunately, we were able to get out with some gains in both months, and we're now sitting on a gain for the year. and I'm pleased with that. I think he was, I don't know when he went into the market, but went from, it's an actively managed mutual fund, but he just got out recently, so he endured some losses, I think. And I want to read you what I read in his email that he said. I was encouraged by the rally that started in January, but in hindsight, it appears not to be the start of a new bull market. Correct. The market may have been anticipating the Fed putting the inflation genie back in the bottle. But now it appears inflation is still too hot to say inflation is under control. Very well said. And that's the anchor that's around the market, and it's around our economy. It's all about inflation, and as I've said before, to kind of repeat myself a little bit, the only way to deal with this, or at least the way that's commonly dealt with it, is raising interest rates, and then they're also selling securities. That is, both of those are going to put the brakes on the economy. And yeah, they'll get inflation under control, but it will come at a price. They keep saying this soft landing, hard landing. I don't see any way to escape it. I think it's going to be a hard landing. I think they've got to get away from this worrying about that and finally just deal with the issue. If that's what their goal is, getting inflation under control, they're going to have to attack it. And I think they see that. The market did not see that in January, but here we are. Anyone who's investing or invested at this point needs to have a game plan to get out because, in my opinion, based on historical patterns, this is not going to last. It will eventually be positive, and I'll tell you when that is. It's just not today. Thank you for watching, and if you have questions or comments, leave them in the comment section below, and I'll respond to them. Thank you.